Welcome to the Chris Dang podcast, where curiosity meets conversation. Get ready to join your host, Chris Dang, on an unforgettable audio journey that will both inspire and educate. With each episode, Chris will engage with a diverse range of guests, from renowned experts to everyday individuals, all united by their fascinating stories and unique insights.
Hey there, I'm Chris Dang, and I'm thrilled to welcome you to my podcast. As a passionate learner and explorer, I'm constantly seeking out new perspectives, ideas, and experiences. And that's exactly what I want to bring to you through these captivating conversations. In this podcast, we'll delve into an array of topics, from entrepreneurship and technology to personal growth and well-being. My goal is to create a space where we can learn from one another, challenge ourselves, and grow together. So, if you're ready to embark on a journey of discovery, hit that subscribe button, and let's dive into the world of the Chris Dang podcast. Stay tuned for our upcoming episodes, and let's get this conversation started. How to valuation of a startup. Valuation of a startup is the process of determining the value of a company or asset. Valuation is part art and part science, but it can be broken down into multiple methods that can be used to assess a company's potential for growth. There are 4 common methods for valuing startups: revenue-based valuation, intellectual property-based valuation, potential for growth-based valuation, and comparable transaction-based appraisal method. Valuation based on revenue. If you are looking to value a startup and have already tried the valuation based on cash flow method, then you might want to consider valuing a startup based on revenues. As long as your company has generated some revenue, it is possible for you to use this method for valuing your business. You will need to know how much money your business earns in sales per month or year before deciding on what % of sales should be used for valuation purposes. You can also adjust this percentage depending on how fast your company is growing and whether or not there are any seasonal variations in sales figures. Valuation based on intellectual property. Intellectual property, IP, is an intangible asset and the most important asset of the startup. IP can be a patent, copyright, trademark, or trade secret which are used to protect the startup from competition and to generate revenue. Valuation based on the potential for growth. The most popular method is to value the startup based on the future growth potential. It's a simple concept. You want to know how much your company will be valued at 1 year from now, 2 years from now, and so on. You then take the weighted average of those numbers and use them as your valuation today. Press tab to write more. For example, let's say that you think your business could be worth $1 million in 3 years with a 50% growth rate per year. So right now it's worth $0. You just started, but 1 year from now it will be worth $500,000, $1 million by 50%. 2 years from now it will be worth $1 million, $2 million by 50%, and so on. In other words, value equals 0, 1 plus G, y comparable valuation method. The comparable valuation method is based on the value of similar companies. This method is used when there is no other method to value a startup. It can be used when there are only a few startups in an industry or when the startup has just started and has no sales record or financial data. The comparable company should be in the same industry as your startup, have similar characteristics, and be doing well. Venture capital method. The venture capital method is based on the future cash flow of the company. It is used to value a startup in the later stages of its life cycle, after it has started generating revenue and profit. This method can be applied if there are no comparable companies to compare with your business or if you're looking for a valuation that's somewhere between an initial public offering, IPO, or private sale. The key assumptions involved in this method include the company's expected rate of growth during its current stage, how much of that growth will be reinvested back into the business, and an estimate for how long it will take before this investment returns more than what was invested initially, known as payback period. There are multiple of ways to value the startup, and it is dependent on the stage of the startup. There are multiple of ways to value the startup, and it is dependent on the stage of the startup. Revenue method. This valuation method is used when you have a working business with a source of revenue, but no sales. In this case, you can use your target annual revenues in order to estimate how much your company could be worth. For example, if you're planning on making $1 million in sales next year and have no overhead costs or debt obligations, like rent, then your company would be worth $1 million. Intellectual property method. In contrast to revenue method, this one is only useful for early stage companies that don't yet have any sales or customers but do have an idea or a prototype that's worth protecting from competitors. You can value your intellectual property by taking into account what other similar startups receive from investors when they're ready to launch their products or services into the market, plus add in any additional financial benefits such as tax savings for having patents, etc. Potential for growth method. This value assessment approach takes into account factors such as market size and demand levels among consumers who want your product. All these factors help determine how quickly revenue will grow over time, so we can figure out how big our company may become down road, which leads us back again towards our ultimate goal, finding out what kind of deal we should get now before raising money from outside sources later down line once everything else starts falling into place like clockwork. Comparable valuation method. This valuation process involves comparing yourself against other companies who've recently gone through successful exits, i.e. selling shares via IPO. One great way we recommend using this technique would be comparing yourself against potential competitors within same industry niche, but make sure not everyone else does this too though. If everyone else does go with this strategy, then chances are high chance something won't work out well enough later on down road. Which means investing now before things get worse later on down journey. Instead, conclusion, there are multiple ways to value the startup and it is dependent on the stage of the startup. The valuation method should be selected based on the type of business and industry, as well as its profitability potential. And that's a wrap on another insightful episode of the Chris Dang Podcast. I want to extend a huge thank you to our special guest for joining us today and sharing their incredible story and wisdom. To all our listeners, your support means the world to me. I hope you found today's conversation as fascinating and thought-provoking as I did. Don't forget to hit that subscribe button to stay up to date with our latest episodes, and share this podcast with your friends and family who might enjoy it too. If you have any thoughts, comments, or suggestions, feel free to reach out to us on social media or via our website. I'm Chris Dang, and it's been an absolute pleasure having you on this journey with us. Until next time, stay curious, keep exploring, and let's continue to learn from one another.